Hello, the fate of the global economy has been one of the main stories, if not the main story of 2010, and will remain very much at the top of the agenda in 2011. At the centre of debate has, of course, been our chief economics commentator, Martin Wolf, who has examined all the issues from quantitative easing in developed countries, currency wars across the world, continuing low interest rates and bond yields, inflation worries, and the ongoing crisis in the eurozone. Well, Martin, thank you very much indeed for joining me. First of all, before we analyse what's gone wrong, let's talk about the global economy in 2011. How are we going to fare?
Well, first of all, we don't know. I always say this at this point. I mean, the uncertainty is always huge, and it's a very good idea to remember this. However, that said, I think the most plausible outcome is one of continuing recovery in the developed countries with some big question marks, but the big developed countries are doing quite well, but not very strong. We're talking probably 2 to 3% growth in the US, maybe 1 to 2% growth in the eurozone. Germany looks much stronger than that. Japan looks as though it's going to recover. The emerging countries are doing very, very well. So plausibly we'll have, with luck, a pretty strong year, and things will look a bit better a year from now than they do now.
I mean, that's all the excitement in the emerging markets still. Is the world relying on growth in those countries?
Well, they're not the engine of growth for the whole world. They're not big enough to pull the developed countries on their own. Ultimately, it will be demand within the developed countries that will pull them, and that is a big question mark. But I think there's a reasonable chance, much better than a reasonable chance, it's overwhelmingly probable that the big emerging countries will continue to grow strongly next year. They've got through the crisis very well, and because they have an internal dynamic, different sorts of dynamics in China and India, but a strong internal dynamic, and that pulls a lot of other countries because they're demanding commodities, so that's giving a tremendous boost to exports from commodities and the prices of commodities. And it does, of course, affect some developed countries. Germany, which I mentioned already, is clearly doing very well out of exporting to these new driving economies in the world.
Let's turn to the United States, because after a dramatic slump last year, it has recovered now. How much of that is down to the fiscal stimulus in the US, and what happens when that stimulus is removed?
Well, actually, the fiscal stimulus, I think, was pretty small. If you actually look at it carefully, and you look at the whole of government, and particularly, so you include the states, who are cutting back very much, and the states are a big part of government spending in the US, there really has been remarkably little fiscal stimulus. Nearly all the deficit in the US, as was true in the UK, was really just the so-called automatic stabilizers, just the result of the crisis. I think far more important was that they saved the financial system. The financial system has begun to generate greater confidence. It's been willing to lend a bit. And above all, monetary policy has been so fantastically aggressive, not only in the US, actually everywhere, but the Fed has clearly led this. And that, with very low interest rates, very aggressive policies earlier in the crisis towards the credit markets, they're financing a lot of the housing in the US. That has helped, I think, much more than fiscal policy. What will fiscal tightening mean? Well, actually, in the US, there isn't going to be any fiscal tightening, or not much. So, nor is there going to be huge loosening. What we've lost with what we've can now forget as a result of the deal between the Congress and the President is that there won't be a big fiscal tightening in the US. And I think that will be supportive of growth next year too.
I mean, you've talked about monetary policy, and we've got this remarkable situation where interest rates, not just in the US, but in the eurozone, here in the UK, in Japan, are incredibly low. How long can they stay at those levels when we've got a risk of inflation coming from rising commodity prices? You mentioned that. Quantitative easing, of course, and growth generally. Can they stay at these levels for much longer?
Well, they're uneasily poised between deflation risks and inflation risks. Domestic price pressures, wage pressures are very, very weak in these countries. But at the same time, and there's a lot of excess capacity, at the same time, there has clearly been a upward drive from commodity prices. I think most of the central banks, the Bank of England is the least likely because inflation is really relatively high in the UK. But I think most of these central banks will treat treat the commodity price rises as exogenous, as external, not something they can do something about. They will look at what's happening to domestic prices and wages, and they will conclude there's not much pressure. So while I no longer think there's going to be aggressive further action, I wouldn't be surprised even if the Federal Reserve did more this year, next year. Nonetheless, I think we're going to see tightening coming very, very slowly. I think the central banks, even in Europe, they are tightening, they're withdrawing special facilities, but I think even in Europe, we're not likely to see any very significant tightening, certainly until the second half of next year.
Do you think the central bankers have done a good job in managing this crisis?
Yes, very much better than the alternative, if we think of the alternative as being the 30s. This was an absolutely gigantic financial crisis, clearly much the biggest financial shock since the 30s, in some measures worse. In aggregate, we saved the financial system. It's functioning, which is pretty important. Confidence is returned, and the central banks have been sufficiently aggressive to keep the markets liquid, to play the role as lender of last resort that they exist to play. They've ignored much of the criticism. They've ignored the, I think, hysteria about inflation, about sort of soaring inflation, which I don't think there's much risk of. I mean, a real inflationary spiral. And they have got us to the recovery. Now, unfortunately, it doesn't get easier now. How quickly you withdraw your exceptional monetary policy, how you adjust to getting back to normal is an art, not a science. And there are many good arguments on both sides on where you should err. But I think actually if you look at the last 3 years, to the extent to which we're coming out of this crisis more or less in one piece, we owe mainly to the central banks.
So they're earning their crust. Well, let's turn to currency wars, because that's been another theme of 2010, and the idea of countries competitively trying to devalue their currencies to help their exports. It's got a little bit out of hand, hasn't it?
I think the rhetoric has got much more out of hand than the reality. The truth is that despite the Chinese complaints, which they're the most obvious source of the complaints, the United States, which has been the main focus of complaint, the Federal Reserve, has not been driven by an aim to weaken the dollar. It's true that it's one natural consequence of their monetary policy, but the truth is the Federal Reserve has a mandate to maintain price stability and to maintain employment. The only thing it could do once interest rates are basically at zero is to expand the monetary base, and it's done so, and it's absolutely right. It's what Milton Friedman, hardly a mad inflationist, would have recommended. Clearly what he recommended. That's what they're doing. Now, of course, if you expand the monetary base, one way or another, it is likely to lead, along with very low interest rates, to a weakening exchange rate. That is part of the adjustment. But that is indeed part of the adjustment. You have to stand back and say, for a long time, the US ran a huge current account deficit. That's no longer financeable. It no longer makes sense because the private sector isn't going to do the borrowing anymore. So there has to be an adjustment. How does the adjustment happen? Well, the current account surplus of the emerging countries has to shrink. The current account deficit of the US and other similar countries like Spain and the UK have to shrink. And that adjustment usually means a change in the exchange rate. So there's nothing shocking about this. The shocking thing to me is the idea that you can prevent this. But of course, for the emerging countries that were reliant on exports in the past, it's a painful adjustment, but it's one they're going to have to get used to.
And probably going to be very painful as well. So if we now turn to the eurozone and the continuing crisis, and after all the emergency meetings of ministers, discussion about amending the treaty, how serious is the crisis that Europeans still find themselves in?
What we can say is we had a lot of incredibly bad lending and borrowing, which was baked into the whole structure of the eurozone, all of which has come to an end. And that is imposing massive adjustment pressures on the periphery, which peripheral countries, Ireland, Portugal, Greece, Spain is also threatened. It's massively raised the cost of borrowing by the governments as the private sector's finances have crumbled. Government finances have also crumbled in the sense that their deficits have exploded. They can't finance them easily. Now, so far what we've done, what the eurozone has done, is provide just about enough money from the other governments and the IMF to prevent defaults. It has sort of financed the adjustment, but the adjustment is still going on, and it's still pretty clear that most of these governments, Spain is on the borderline, find it very difficult to access private finance, and that is just going to go on. The crisis is going to be a rolling crisis, and we don't know whether they'll manage it.
I mean, very, very briefly, within that crisis, some people have been speaking the unspeakable, that the eurozone may end, that the euro may cease. Essentially, I suppose, Germany seceding and bringing back its old beloved Deutschmark. Is that credible?
Well, it's certainly credible, and that's part of the problem. I think I think it's an outlier possibility, but the possibility isn't zero. And if you're an investor, the fact that it isn't zero is something you have to take into account. So one of the things you're looking at here is the return of exchange rate risk in this way. It's one of the factors affecting the bond market. Fundamentally, my own belief is that it's overwhelmingly probable that the eurozone will survive, that it will survive with its current members, at least for the next year or two. In the long run, I'm not sure about that. I think some members may find it impossible to live with this. We don't know. But there's no question the possibility has now returned to the consciousness of everybody. And that makes it more difficult to make action to stop this credible.
And very finally, Martin, the crisis, not just here in the eurozone, but around the world, the crises, are they really a problem for politicians rather than economists?
Well, they're certainly a problem for both, and ultimately all economic crises have, in some ways, political roots, and they require policy changes to deal with, both to prevent new ones and to deal with old ones. So I tend to the view that the economics drives the processes, and you can never say, politicians can't be Canute and say, this must stop. At the same time, economics alone won't resolve these things because they're so deeply embedded in political decisions, and the eurozone is a perfect example. It was a political creation. It takes political will to keep it going.
There's the voice of an economist. A very happy 2011 to you, Martin Wolf. Thank you very much indeed.
Pleasure.
Thank you.
Thank you.